Hey guys, Justin Beckman, President and Founder of Access Property Management. Hey, today we're meeting with Mike Murphy from JB Harrison Insurance. Great to see you, Mike.
Happy to be here.
Thanks for being with us, and I hope you can really
Yeah.
pour some information on us and what to look for and what we should be doing today to protect ourselves.
I'll try to keep it as non-insurance jargon as I can for everyone. But yeah, no, it's risky times. I mean, we've talked to more clients in the last 90 days about, riots and lost rents due to COVID and pandemics, and people are paying attention more now than they ever have before because of what you just said. It's uncertainty, and that gets people nervous when before it was more on autopilot and they just paid their bills.
Yeah.
So yeah, people want to know, am I covered if someone throws a rock through my window downtown Grand Rapids, or if my business burns up because of protest or vandalism.
So let's stop right there.
Yeah.
Are people protected? Is a general person with a general rental policy, a rental dwelling policy for the rental property, if a protest started in front of their house or rental property and the windows got smashed, the property got burned down, would that be covered today if it was a riot?
Depends on the policy. If you think back to, let's say 10 years ago, even 15 years ago, when people in Grand Rapids, Michigan were buying a house for 30 grand. You probably know some of those folks.
I was one of those guys.
Exactly. Did you really want to insure it with all the bells and whistles and with replacement cost coverage? And probably not. So those policies that haven't been revisited in the last 10 years probably have a huge problem because they're on basic form, which covers fire, lightning, wind, or internal explosion. Vandalism or malicious mischief or riot, all those civil unrest, all that stuff is on a special form or more of a open perils policy versus a basic policy. So when you get into it, they're not all created equal. They're far from it. So knowing what to look for and knowing how to have someone talk to you the right way is important.
I totally agree. So let's go back. So 2001, we had 9/11 happen. Twin Towers were struck. The Pentagon was struck by international terrorism. Were there terrorism riders and insurance policies back then, or is that a new creature that derived from the terrorist attacks of 9/11?
It derived from the terrorist attacks of 9/11. Terrorism is now included on every policy unless it's specifically included on commercial lines.
Okay. On commercial lines.
On commercial lines.
So not consumer, or is that consumer too?
On commercial lines you can do an exclusion. On a personal lines like a rental policy, they're not all the same.
So what I'm hearing then is, let's say someone says, hey, I got these great smoking deals for you. This one I can save you $300, $350 a year on this premium, but I just need you to sign off on this waiver, this exclusion.
Well, yeah, they're gonna make you buy terrorism coverage on an apartment complex unless you sign a specific form saying I for $7 choose not to insure for acts of terrorism.
What about in a single family home?
Single family home, you got to read the policy. It's different than commercial lines.
So is there a difference? So a lot of times in finance, there's different rules for business commercial activity than there is for consumer activity. Is that similar with insurance?
Yeah, but a lot of times you'll see someone who has single family properties and they're all lumped together on a commercial plan because they have so many. So the investor that has 10 plus properties is going to be on a commercial plan where you're going to have terrorism included. Someone who's buying a one-off or a two-off here and there on a personal lines rental dwelling policy, it might not fit the same mold.
If someone today is buying a property with debt, with leverage, are the banks going to require that they have terrorism coverage? Is that a standard requirement from lenders today?
No, they just want their investment protected up to the right limits. So let's use 100,000 for the sake of argument. They're wanting to make sure that 100,000 is protected, so they're probably going to want replacement cost coverage versus more of an actual cash value or market value approach. So yeah, I mean, banks don't mess around. You know it.
Well, let's go back to the terrorism. So
Yeah.
What happens if it was deemed a terrorist event, domestic terrorism? What happens then when something's deemed terrorism? Because words have a meaning, and when our leaders are declaring certain events as state of emergencies, I think that has a meaning potentially. From an insurance perspective, I don't know, but it definitely does from a government's perspective.
Yeah, I mean, civil unrest, riot, terrorism, they all fall in that same line of, vandalism or malicious mischief. I'd rather have it all. I'd rather have every single one of those words on my policy. So whatever hole or box they want to put the cause of loss into, I've got that one covered. I don't want to say, I don't have vandalism or I don't have terrorism or I didn't have riot. I just had basic fire policy. Well, there's a huge difference there because what causes a fire? Well, electrical can cause a fire, anything, you
Sure.
keep going.
Sure.
So fire is not fire.
Sure.
So, yeah, no, it really comes down to just looking at the actual endorsements of the policy or having someone explain them to you versus just taking your eyes right to the bottom line of that page and saying, hey, it's 500 or hey, it's 1,000.
I want to give you a scenario here, and
Yeah.
I want to give you two different scenarios. One is a person that has between, let's just say, 1 and 5, single-family homes, rental properties or duplexes, condos that they've purchased over the years. They were putting together for their nest egg for retirement. And then I also want to talk about someone that has maybe 20 properties, 30 properties, someone that's really acquiring heavy. You have a passive ownership side of it, and we have an active side of it. Can you maybe walk me through those two scenarios?
Well, there's one similarity between both. You want as much liability as you possibly can afford.
Liability coverage.
Yeah, as much liability coverage you possibly can
So
afford.
what does that get us? Let's start at the basics. What does liability coverage get us?
Okay, liability is going to cover you for your premises. You're going to have
Trip and fall.
yeah. So
Ice.
tripping for medical payments to others. You'll have premises liability. You'll have personal injury liability. Libel, slander, false arrest. Liability is number one. Buy as much as you possibly can afford because it is your least expensive peace of mind.
It's
And
cheap coverages.
for the active investor like you were talking about who's acquiring, they still need to protect their assets as much as the person who's sitting on $3 million of real estate that they've had for 20, 30 years. You don't want it to be taken away for an accident or something small. Transfer that risk from your pocket to the insurance company's pocket and buy as much liability as you possibly can afford.
We were talking before the video today, and Mike made a comment, and I've been around insurance for a while, and I'd like to say I thoroughly enjoyed understanding learning, and I do. It's just a complex area, right? It just is. But you made a comment, just really simplified it for me, and you said that you insure for the big items, you insure for the big risk, the big loss.
Yeah.
The rest of it's part of business operations. The minor items. So you have to put that in perspective. Like, what are you really trying to accomplish here? And I think that's what's really important. Like, first take a step back. Like, what are you trying to accomplish? I think you have to start with the end in mind. And if you're trying to, build up a nest egg over time, you want to take certain strategies that are going to help you minimize and mitigate the risk. And you wouldn't want a risk in one building to necessarily roll over to a building that's totally unrelated. So there's different strategies that you can use.
Yes, and some of the things that I say is high liability, high deductible. If you can afford, take risk where you can afford to take a risk and it's very calculated. I know that if I have 100% replacement cost or guaranteed replacement cost on my apartment building, I have high liability, I can offset the cost of all those good coverages by saying I'm going to take a $10,000 deductible or a $5,000 deductible. I know that if something bad happens, I'm into it for 5 or 10. But that's very calculated, measured, and I can plan for that. What I can't plan for is a huge, massive hole in my coverage that I never was told about or talked about, that all my money's pouring out that gap, and I didn't know how to stop it because I was never told. That's really where you take risk where you can afford to take risk and where it's calculated, and then the rest of it, transfer it to the company. That's what it's for, the large stuff.
You kind of hit on a little bit here with replacement costs.
Yeah.
So when you see a policy and they say sometimes actual cost or replacement cost or depreciable value,
Yeah.
Can you help us understand and shed light to everybody? Because even myself, I look at a lot of policies that renew every single year, and still there's very subtle differences that are very important to understand there.
Yeah, and we've looked at several policies together with mutual clients and things, and a lot of times when there's a bank involved, sometimes those people have the best policies because the bank forces you to look at all the little things that you
make sure they're covered.
Make sure they're covered, and which in turn covers the borrower as well. But let's go to that investor who doesn't have a mortgage.
Yeah.
Or it's just a group of private money.
Yep. Private equity.
Private equity. There's a lot of that.
Absolutely, there is.
And there's no set of rules or guidelines. They're just going through it and hoping on the professionalism of their agent or their manager to work together to make sure that they're putting themselves in the best position possible.
So what should they be doing for themselves if they don't really truly have an advocate? And what are the basics that they need to understand around the concept of replacement value?
Yeah. So actual cash value, replacement cost, agreed value, blanket coverage. We'll hit on all those kind of. I won't submarine. I'll just scuba dive real quick.
Yeah.
But actual cash value, that's more of a replacement cost. Take depreciation away, gets you your actual cash value. So think of a car. A 2010 vehicle is not worth as much as a 2020 vehicle. Over time, it depreciates, just like a house.
Well, I think of depreciation, like, I see just more money in my pocket. That's how I think of depreciation. I love depreciation.
Yeah, but remember when I talked about taking risks and calculating your risk? Well, a claim with actual cash value is a huge unknown to that property owner, because you don't know, is the company going to take 20% depreciation, 30%? Are they going to depreciate?
Do they go off the IRS depreciation schedule?
No, they go
27
off.
and a half years, or
No,
what do they use?
they'll look at the roof. Hey, the roof's 10 years old. Well,
Say itemized depreciation.
yeah, yep. Roof,
System
flooring.
by system.
Yeah, system by system through a property. Well, imagine it being a 16-unit building. Oh man, and you're on actual cash value. You could have a deductible and then a huge chunk of depreciation, and here's your check when you thought you were going to get 100,000, you get 65. That doesn't make you feel very good.
Well, you could be out of business.
Well, it depends on the person. Everybody's financial situation is different. That's why everyone, these.
Understood, but if you got the check, let's say you had complete loss, and again, we're using hypothetical numbers here. These aren't even real numbers in today's market for sure, but let's say it's going to cost $100,000 to rebuild, but then they give you $60,000. Well, you're $40,000 upside down.
Mm-hmm. So you better have that in the bank, or you're not going to be able to replace the property.
Let's multiply that by times 10, and you're $400,000, negative. So that's a huge gap, right? So it's kind of funny because you hear actual cash value, like, well, I'm going to get what it's worth. It's kind of a play on words. It almost feels like. I don't know if it's intentional, but it kind of seems that, not that it's intentional, but it seems like it's a play on words. Like, you think you're going to get like the true value of it. What would the market give me today? But that's not the case. You have depreciation.
Yep, actual cash value has depreciation plus the deductible. Replacement cost, on the other hand, is new for old in the event of a claim. After the deductible is taken away, here's your settlement. So let's take a roof claim because everyone can understand that.
Hail, tornado,
Yeah.
tree.
Roof's 15 years old. It's probably halfway through its usable life, or a little more than halfway through its usable life. Wind comes through, shingles are all gone on an apartment building. $5,000 deductible. Here's your check for X of the roof after less $5,000. I mean, replacement cost coverage. That makes you feel pretty good when you know I've calculated my risk to know that it's going to be replaced after my deductible. Agreed value means you and the company both agree it's worth $100,000. If you're probably doing agreed value, you're probably doing blanket coverage where you have multiple properties all in the similar area, and multiple properties around town, and you're blanking that limit together. So if you're short on property A, you can borrow from property B, as long as you're insured to value.
Now, is there an inflation adjustment tool in there? Like, let's say we wrote this policy 5 years ago. Is that agreed upon value? Is that agreed upon each year, or is there an annual inflation?
Oh, you'll get a statement of value. If you have agreed value policy, you'll get an application every year that says, here's the statement of values. There's a little inflation guard in there, but you and the company have to re-agree every year and sign off on it. But yeah, to me, on larger real estate where you're talking, larger rents, larger risk, larger replacement cost,
But what do you consider larger? I mean, let's be a little bit specific here, so that way if someone.
Okay, a residential risk is a 1 to 4 family house. A commercial risk would be a 5-unit and up.
Okay.
So
similar to financing, 1 to 4 is residential, 5 plus is commercial.
Exactly. Very similar. So depends on the person's financial situation, but I always sit down and counsel people and say, hey, where are you? What's your position on the property? Mortgage, no mortgage. Ask questions, because what that person tells you
I think that's huge. I think that's huge. I think the dialogue needs to happen before. Like, what are you trying to accomplish? Like, ask these questions. Like, what are you trying to cover? And
do a review, because if you don't do annual reviews or even a bare minimum every other year, things can get off track pretty quick. Especially with values, multiple policies. Even the economic climate you're in. Think about where we are right now. Labor, materials, all those things are just crazy variable right now. Well, if you have a loss during one of those crazy times, you better make sure you're well prepared.
Let's talk about replacement value as well. Can you hit on the actual replacement value?
Yep, replacement cost. You're going to take a number to rebuild per square foot. You multiply that through the property. On an apartment building right now, depends. Average construction, you're probably 125 per foot, somewhere in the neighborhood. Maybe 150 on a more high end, not high end, but more of a
higher end of coverage.
Higher end of coverage, yeah.
Sure.
So it's a cost per square foot. Cost of labor, cost of materials, and then there's also cost of demolition. Yep. So there's a lot more than just the cost to rebuild.
So, what would you choose? if your property, what would you be? How would you insure your property?
I would,
And
I
why?
would, I would employ a strategy of high liability, high deductible, full replacement cost. If I had multiple locations, I would do blanket coverage. That way, I know I'm really gonna have a hard time being short because I'm gonna be able to borrow from Peter to pay Paul, so to speak. Borrow from location B. If location A was, hey, we don't have enough limit here. We were insured to value last year. We're short. Borrow it over, blanket coverage.
Value, and I know that in years past, you can be penalized if you don't adequately insure your premise.
Yeah, it's co-insurance.
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 Can you explain what
Yeah.
co-insurance means?
Co-insurance is what you did insure the property for at the time of loss, divided by what you should have insured the property for. And if we had that cool little graphic up here, you do a little math calculation, times your loss after your deductible, and take your deductible away. So let's use $100,000.
Okay.
And most policies, the co-insurance is going to be 80%, 90%, or 100%. Well, you don't want 100% because that means you got to hit a bullseye on that valuation every year.
No room for error.
No room for error. 90% means you have 10% wiggle room.
So if we're at $1 million, let's say $1,000,001, I'm okay. $1,000,001, I'm not okay.
Yeah. So getting back to what you did insure the property for, let's use $1 million property at 80% co-insurance. So that means at the time of loss, you better have at least insured at $800,000. But you don't want to be treading so low that you're pushing the limit. So let's say you were underinsured. You had it insured at $750,000, and you should have insured it at $1 million, and you had 80% co-insurance. Well, now it's 750 divided by $1 million. It's 0.75 times your loss equals. Let's say your loss is 100,000 equals 75,000 on a $100,000 loss. Now you take your 2,500 or 5,000 deductible out of that, and you're sitting on, let's say, 70 grand on a $100,000 loss. How does that make you feel?
Yeah.
Sure.
So that's, I wanted to bring that situation up specifically because so often, before COVID stuff, whatever, but you might get a term sheet or like a insurance rate sheet in the mail. Like I can get you for this amount per year, on your property. And I guess my point is, you need to understand how it's being written. All policies are not equal. They are uniquely different. They can be written pretty much however they want within the confines of what's legal as far as insurance. I'm sure it's a regulated industry, obviously, but
Yeah.
within that, it can be written several ways. So they're not all the same, right?
No, they're not. But there's one common factor that everybody does, and you and I are both guilty of it. How much does it cost me?
Right.
Well, how much does it cost you today versus at the time of loss is a huge difference. Saving a little bit of money now might cost you a ton of money later. So I'd rather have a value, and what's value? To me, value is knowing what I have, insuring against the large stuff, offsetting, like I hate to be a broken record, but offsetting with a high deductible, and then taking chances where you want to take chances, but at least you're choosing what to cover, not to cover. You're buying all the bells and whistles, and then maybe you're backing off certain things for exposures you don't have. Water backer with syringe.
I was just going to bring that up. That's a huge one, right? That's a big one.
You're on high ground, or you're on sand. You're never going to have a water issue, or you have slab construction where you don't even have sump pumps. Well, you might be able to trim some of that stuff out of your plan, but at least you talked about it and you had that conversation. I'd rather be crossing stuff off versus, not offering those things to my customers.
Yeah, I see the way that I operate. I always love to just give me all the options. Tell me everything that's everything that's an option. Let's talk through it. See if it makes sense for us. Do we really need it? Is it that important to us? Let's make choices on those on a conversation. I think that's what's important is the educational part of it. And too often people are just like putting a number in front of you. Well, I can get you lower. I can get you lower. And the truth is, we do shit. And so, full disclosure, we use Mike for several policies, but we still shop them out every year. And it's when we do leave and we have leftover times, Mike. But it's not about Mike. But it's just the business of having relationships, finding a couple people that you can work with. And then sometimes the marketplace has different appetites for exposure to risk, right? With different coverages, different.
We had that a couple months ago. One of your customers, let's call it Company A, pulled out of the market. If somebody's undercutting the market by 20 or 30% to the nearest competition, it's only a matter of time before they price themselves out of that market because they can't afford to take some of the losses that are naturally going to come their way.
Right.
The habitational risk is what the industry would call it. Residential real estate or apartment complexes. If you're the lowest one on the block year after year after year and you sustain a lot of large losses, you're not in business anymore.
Yeah.
So when you start pulling policies back, something you could have gotten for $7,500 in 2019 is now $12,000 or $10,000 in 2020, where it probably should have been all along. But if that company's going to be able to maintain a long-term steady policy with you versus doing the yo-yo game, it's probably better.
Yeah.
Because you're going to lose stuff in translation. When you bounce around, not everything lines up. So you got to make sure you're not missing anything.
Yep. So Mike's referring to one of our properties that we just did have a significant jump. I think our premiums jumped up 25%. And we had opportunity with one property where, a separate property where there was potentially no providers for insurance. We have a student housing apartment complex property, and it's been a challenge over the years. Sometimes they're willing to insure it, other times nobody wants to touch them. And I feel like I don't have control sometimes over my risk to them, that expense, because I have to have coverage, which is just part of our strategy.
Where you can control it is not turning in all the little stuff. Even if something is $6,000 and you have a $5,000 deductible, don't go running for that $1,000 check in your pocket, because next year when you have a $60,000 loss, you're going to want to go to them for that. If you can self-insure even for the small stuff, again, this sounds familiar, but self-insure for the small stuff, then when the big one happens, you're not gonna have that third or fourth claim. It'll be your first or second claim.
Yeah.
So that's just the way I look at it, and you want to manage it for the long haul. Not just like you want to hold that property and have residual income for the long haul. You want your insurance to be there for the long haul. You want your loss history to look favorable. So if you do need to market that property, you're not going to have a bad driving record, so to speak, because it follows you.
So let's talk about that real quick.
Yeah.
Loss runs.
Yeah.
What are loss runs for those that may not understand what loss runs are?
Yeah, it's essentially it's your loss history report.
Your credit card or your credit report. Or your,
it's how that property is performed from a loss standpoint, or how profitable that's been for the insurance company over the last 5 years. Some companies want 3, some want 5. In your industry, most of your customers are probably going to have to show 5, just because the losses in that area are usually higher than us.
So I approach you for an insurance policy.
Yeah.
And you're like, hey, show me your loss runs. We want to see what your history is as a customer. How did you operate? How did you manage that property? What did you claim? What didn't you claim?
Yeah.
Right? Is that what you guys are looking at?
Yeah. Hey, weather-related claim versus, something that was a trip and fall because they didn't redo the parking lot. Well, what's the more favorable one to look for?
Sure.
The hailstorm that the owner had no control over, or the parking lot that they had 100% control over?
Negligence of of de-icer and whatnot.
Yep.
Sure.
Yep. And again, working with, are they professionally managed? More times than not, the professionally managed property, I'll plug you here, is much more favorable to an insurance company over one that's just being someone self-managing and not staying on top of a lot of those issues that we're just describing, because they all add up. And it's all part of the puzzle that the company looks at.
Absolutely. Mike, I'd never think of doing insurance myself, as far as trying to figure it all out myself. So many people, they try to do the right thing, and they're trying to maximize the dollar and spread the dollar, which I get, it makes sense, and that's the right thing to do. But don't be cheap in the wrong places, because being cheap in the wrong places can really screw you.
Yeah, there's one other thing I want to bring up before we're done talking today. It's ordinance or law.
Okay.
Ordinance or law. Think of a property that's built in the 60s or 70s.
Plenty of them.
Building codes were different back then, right?
Mm-hmm.
Didn't have to have doorways wider for ADA compliance or elevators or hardware smoke. I'm just going through the list here.
Sure.
You know all the code issues now. So let's say that 1960s or 70s property has a loss. All those things that were grandfathered in are now, when you're pulling that new building permit, are going to be required. Well, making sure you're insuring against all the new city ordinances or laws that are going to be required for you when you rebuild that property. If you don't have coverage or the right limits for coverage under that, you're going to be way short of claim time, because the city's not going to let you get an occupancy permit unless you satisfy all their code.
Okay, so a cinder block facility or a community that was built using very rough construction standards back in the 60s or 50s, much different than 2020. So maybe the replacement cost, let's just say $750,000, or this is going to $1 million, easy number to use there. But the cost could be 25% greater to comply with the new.
Yeah, you might have an extra $100,000 to $150,000, let's be generous, of code issues that your insurance doesn't have to cover unless you have the right ordinance or law limit. So that all goes in with the replacement cost. And ordinance or law is, let's say a building is burned down 50%. The city could come in and say, hey, you got to tear down the other undamaged portion. That's our law. Well, now you have to have insurance to tear down that undamaged building, additional demolition coverage. Then you have to have additional limit for the increased cost of construction, all those code issues. I mean, that's where if you read magazines on where some of these larger buildings fall short on insurance limit, ordinance or law is right up there with not having a right replacement cost.
So it could be a game ender.
Yeah. Yep. Think of a big brick building in downtown Grand Rapids. Is that going to cost more money to demo and remove, or the frame building out in the suburbs? You know what I mean? Think of it that way. You're going to have all these extra costs that you're just thinking about how to rebuild it. Well, you're not thinking about all the other outside influences that you're going to have to comply with.
Historic preservation.
Yeah. Yeah, you don't want to. Yeah, the historic homes. That's why companies run from those, because they know they're going to be dictated to on how they have to rebuild the trim and the doorways and the window. They have to do everything to the look of the historical society. So yeah, can be interesting.
Yeah, a lot more there to deal with.
A lot more to deal with. So yeah, all the right bells and whistles, high liability, high deductibles, making sure that you're going through a checklist with somebody, not just checking your premium, but actually checking your endorsements, your limits.
Yeah.
You know, who's insured. Who the named insureds are lined up right.
Additional
insured. A lot of times your manager wants to be listed as additional insured.
And why would they want to be listed?
Well, they want to share your limit. So if you're both dragged into a lawsuit, your policy is going to defend management company ABC along with the property owner.
Because they're acting in your interest as your fiduciary to represent you anyway.
100%. So yeah, there's a lot more in the detail. The devil's in the details. Well, it usually is.
Sure is. One of my best mentors that's been in my life for the last 12 years or so, and that was actually longer than that, 13, 14 years. And one of the things he's really instilled in me is the devil is in the details.
Yeah.
You know, and I've really grown to appreciate that, to pay attention. Even if I don't fully comprehend it, I know enough to be aware enough to ask people that do understand it better than me. Because we don't need to know all the answers ourselves. We need to know who does know the answers. So in this case specifically, Mike's one of my guys that I go to, and we do have other insurance people that we use for different products, and that's okay. And Mike's not offended by it.
No,
Mike's a great guy. Mike's a great friend.
We've had talks about properties that I just don't have a market for. Let's go back to a student housing community. That's a tough risk to place, but I certainly can look at it and say yeah or no or consider this.
Yep.
You know, I mean, there's certain. Not everyone's going to be a generalist for every risk.
Absolutely. And I guess the message I really want to share with our investors out there is build a relationship, and it doesn't have to be with Mike. And if you like Mike, great, hit him up. Mike's a great guy. Let him go through your stuff. Let him check it out. I mean, it's not doing it to give you the cheapest quote, but like let somebody else look at it. You know, I've learned that it's really important to bring. If you've been getting information from one person for a long time, it's really important to get consistently new information too. Just to make sure it's still relevant, it's current, and you're getting the accurate, right information for you. Because at the end of the day, it's about you. It's about your needs, about what you're trying to accomplish. It's about your vision for the future, what you're trying to grow and build and protect. And protecting is part of that. That's what's really important. Why go through all the work and the agony and the suffering? Because it takes a ton of work to find a good investment property and to take it down, to find it first, and to compete and to win the bid, and to take the property and to turn it into a successful operating revenue stream. It takes a lot of work. And when you have that, you want to protect it. And so what we're talking about today with Mike is just one of those things. It's just one of the checks of the boxes of what we need to do to protect our assets. It's part of our plan, part of our strategy for protecting our assets and really protecting our ass. So
I knew you were going there.
we live in a society where it's so freaking litigious, and you have to be. And to think that you don't have a chance of being sued is naive. We live in a very frivolous society, and I think that you need to be prepared for anything that you can comprehend to happen. So, again, guys, I guess my closing thoughts are I just really want people to be prepared, to be aware. We have kind of a pause in this kind of COVID thing a little bit, even though it's heating back up. But check into it. You have some time. Reach out to your current insurance agent, and then go talk to another insurance agent. Find somebody that you like. Go for a beer with them. Get to know them. Build a relationship. I've been working with Mike for
on and off 10, 12 years.
I think it's longer. I think it's 2005, 2006, 2007 maybe. I mean, it's been a while. It's been a while. So, find good people, and you can build a great business, and it's a lot more fun when you do it with friends. So, Mike, any closing thoughts? Anything that you want to throw out there? And just
like I say, reviews are good. Annual reviews, either right now by phone or Zoom or even face to face. Annual reviews are really the way to avoid any of these issues we're talking about today, because as things change and evolve, and your properties change and evolve, and your situation changes, it doesn't stay static. It's dynamic. Your business is dynamic. That's why I always tell people. So your insurance needs to be ever changing with your exposures.
Yep. And ever changing as your equity position changes.
Yeah.
Too,
Yeah. Exactly. 5 years ago, you might not have been able to take that risk. Now today, you could. Well, take advantage of it.
Yep. Absolutely.
Take advantage of it. So I really appreciate having me on today.
Yeah, Mike, great seeing you. Wish I could shake your hand, but that'll be another day in the future. But hey, how can people get in touch with you? Let's just give a quick plug out. This isn't an advertisement, guys. We're not plugging Mike, trying to just give him business. Like, I want you to understand insurance. It's just part of the triangle of protection. It's just one of the pillars that you need to address. So how can people get in touch with you?
Yeah, probably an email's best, or phone call. My email would be Mike M for Murphy at jbhins.com, and my phone number is 616-868-0050. Agency name is JB Harrison Insurance.
I was gonna say, so better than trying to remember any number or email address, just Google JB Harrison Insurance.
www.jbhins.com.
And it's in Hastings,
Alto, Michigan.
Alto.
Just on the east side of the airport.
Okay, just on the other side of the airport. So,
Yep.
Hey, guys, go find a good agent. If you don't have one, you really need to. They're looking out for your interests. They can come up with some really creative things. You can still be prudent and still get good coverage, and that's what we're really talking about.
Yeah.
So, Mike, again, great to see you.
Hey, thank you.
Thanks for coming out here to Rockford, and we'll see you soon.